Hello everyone, welcome to JAIIB CAIIB English Medium. My name is Aarti and I hope you all are doing good. So as you know, this is a target series where we are completing important concepts. Along with that, we are practicing. Yes, because for November 25 AFM, you require practice plus conceptual understanding. Now, one more update before we proceed with this session, that your registrations already started from 1st August. So try to register as soon as possible. And while registering, if you face any problem, please ask us through the comments, or you can join our Telegram group also. And that Telegram group link is already available in our chat section as well as on our description box. So let's start today's session. So today we are going to talk about your unit 25 important topics, that is capital investment decisions and term loans. So here we have two sides in this particular unit. One is your capital investment decision and next part is your term loans. So basically today I'm going to cover your first side, that is capital investment decision. So let's start with the first thing only. Let's understand what is this capital investment decision. See, decision means what? When you need to select any one alternative. Yes, like after clearing 10th standard, you got the option to go with the science stream, to go with the commerce stream, to go with the art stream. Yes, so you opted suppose science stream. So that is the decision you have made. Correct? So this is the meaning of decision. But in your AFM, we are talking about investment decision. Means what? Suppose if I am holding rupees 1 lakh. Now with this 1 lakh, whether should I purchase jewelry? Yes, or should I purchase some shares, or invest in FD, or go with the mutual funds? Now, I will evaluate different options where I can invest this 1 lakhs. Yes, and when I'm evaluating what things I'm going to search, I will search what returns I will receive. Yes, what returns I will receive and which of the options are, less risky as well. In options which are having less risk. So suppose if I'm saying if you go with the jewelry, the risk is suppose 10% and the return is just 5%. Shares, I can say you are going to receive suppose 16% return, but risk is suppose 20%. With the FD, you are earning suppose just 7%. On the other hand, there is zero risk. Mutual funds, you are going to receive this return suppose 15%, but risk is suppose 7%. Yes, I have evaluated this different options. Now, after analyzing each options, I can say mutual funds is your best option. Hana, in this you are receiving good return as well as minimum risk we have. So what as an investor we will do? See, FDs, that 7% is very minimum amount. The inflation rate is around 6 point something. Yes, so I'm not going to earn anything. Whatever I'm earning, that is equal to inflation price. Yes, so what I will say, FD is okay, but if I go with the mutual funds, I am earning a good amount of return. Even I have to I have to face some risk. But that is very minimum compared to remaining options. So when I'm going with the mutual funds, then let's invest my 1 lakh rupees in this mutual funds, then that is the investment decision I have made. Yes, this is the investment decision I have made. So what is investment decision? It refers to selecting the best options by evaluating and analyzing for the business. Like from this options, I have selected mutual funds. Correct? This is the best option by evaluating, by analyzing return as well as understanding the risk. By analyzing these things, I have evaluated and analyzed for the business. Correct? Same concept. As an individual, what we are doing, what we are calculating, the same thing businesses are doing. Okay, so this is what investment decision. Now let's talk about from the business point of view. Suppose here is your company and the company wants to invest rupees 10 crores. Now what they will do, they will identify the projects. What are the projects? What are the options they have? Suppose in your first project, they want to manufacture car electronic vehicle. Yes, they can start this electronic vehicle manufacturing. Now in your second project, they evaluated that they can start this solar panels. Okay, so these are the two options which this company identified. Now, in both the companies, if they talk about, the investment amount is 10 crores only. If they go with the project A, 10 crores they will invest. If they go with the project B, they will invest 10 crores. Now, what they will do? They will identify the return. What they will search, the next thing, they will start analyzing, evaluating. So, the first thing they will talk about the return. If they start this electronic vehicle, what return they can earn? Here, they can earn, suppose, 45%. This is the return amount. If they go with the solar panels, they can earn, suppose here, 27%. Okay. Now, next thing they will talk about, that is risk. So here, suppose risk, and if they go with the electronic manufacturing of the cars, their risk is suppose 9%. And if they go with the solar panels, their risk is suppose 13%. So this is the analysis they are going to do. Now after understanding that, okay, if they go with the car electronic vehicle, their return is high as well as risk is low. Return is high, risk is low. But if they are going with a project B, that's solar panels, their risk is 13% and their return is also 20%. So as a rational investor or as a management, what I'm going to select? Of course, project A. So when I'm going with the project A, that is what decision I have made. Yes, what future return I am going to earn, what risk I am going to face. So if I am calculating through this kind of, analysis, evaluations, then that is what investment decision. So this is your investment decision. Correct? I hope everyone understood what is the concept, what is the meaning of investment decision. Now, after that, let's talk about the methods. Okay, we have methods of investment appraisal. For calculating this investment decision, for making that investment decisions, we have major two sides. First one, when you can use non-discounted methods. Next side, discounted methods. If you divide the major part of this investment decision, you have two sides. First, non-discounted methods. Next, discounted methods. Now, what is this discounted methods? Leave for some time. Yes, let's talk about non-discounted methods. Under this, you have two methods. Number one, that is your payback period. Second one is your accounting rate of return, ARR. Payback period method and accounting rate of return. These are the two methods covered under non-discounted methods. So let's start with the first one, that is payback period. Payback period is a very simple method. Now, as per this method, if I take with example only, okay, so let's start with one example. Suppose today I purchase one car for 5 lakhs. I purchase one car for 5 lakhs and now I'm going to use this car for rental purpose. For rental purpose, and every year I'm going to generate from this car, suppose 2 lakhs. Not 2 lakhs, for a time being, let's say every year I'm going to generate 1 lakhs. From rental, I can generate yearly per year 1 lakh as my rental income. Again, I am repeating this example. If I purchase one car by investing 5 lakhs and after purchasing, I am going to use this car for rental purpose. So, I will earn the rental income, that is 1 lakh per year. So, my question is that if you earn 1 lakh per year, in how many years you can recover this 5 lakhs? Tell me. In how many years you can recover your invested amount? Okay, so let's see. 1, 2, 3, 4, 5. Okay, so first year also 1 lakh I'm going to earn, second year also 1 lakh, third year also 1 lakh, fourth year also 1 lakh, fifth year also 1 lakh. Means I will get this 5 lakh return after 5 years. 1 lakh, 1 lakh, 1 lakh, 1 lakh means within my 5 years I will recover my invested amount. And this is what your payback period means. Payback means whatever you have invested, in how many years you will get it back. Yes, that is what payback. And what is the time period? That is 5 years. So what is the payback period here? Within how many years you can recover your invested amount? That is your payback period method. Now let's read this. So payback period is the period at the end of which the initial investment is entirely returned to the investor. So as per this example, I am going to recover, yes, as per this example, I am going to return, I will get the payback period as 5 years. Correct? So this is how we are going to calculate. Payback period means the simple calculation, what we are always doing. In how many years we are going to recover it? Just by adding. Yes, whatever the future incomes we are analyzing, we are just going to add it. The same thing payback period talks about. Now, it is to be remembered that both the positive or negative cash flows are to be added till the total net cash flow equals the amount of the initial investment. So what is the formula here? Payback period method equal to amount to be initially invested divided by estimated annual net cash inflow per year. So here if I use this formula, amount to be initially invested, that is what? 1 lakh or 5 lakhs? What is your investment amount? 5 lakhs. 5 lakhs divided by estimated annual net cash flow per year. Every year, what is your annual return? Yes, that is 1 lakh divided by 1 lakh. So here your answer is 5 years. Yes, this is your payback period. And as soon as you calculate this period, you will stop calculating. Yes, this is a very simple method, and if in exam they're asking this type of questions, I know you are going to tackle it. Yes, so let's start with a question. Let's practice. A company plans to invest 8 lakhs in a project. The project is expected to generate a constant annual cash inflow of 2 lakhs. Calculate the payback period. Payback period equal to, here, your initial investment divided by estimated annual cash inflow. Initial investment is your 8 lakhs divided by 2 lakhs. So your answer is 4 years. This is your payback period. I hope everyone got this answer. Okay. Now, so this is the one method we have completed from non-discounted methods. Non-discounted methods, we have 2 methods. So we have completed this first one. That is your payback period method. Now let's talk about your discounted methods, and we have 2 methods again under this. That is your net present value, and the next one is your internal rate of return. These are the 2 methods which we are going to cover under the discounted methods. But what is the meaning of discounting? Yes, what is the meaning of this discounted here? So first, let's talk about this. What is the meaning of this discounted word? So discounting means this is the discounted cash flow, DCF, is a valuation method. This is a valuation method that estimates the value of an investment using its expected future cash flow. And as an analyst, we are going to use DCF to determine the value of an investment today based on projections of how much money that investment will generate in the future. That is what discounted cash flow. So now if I take one example and if I discuss this discounted cash flow, means if this is a 0 time period. Okay, this is your this is your 0th time period. Correct? Now at this 0 time period, suppose I am investing rupees 4 lakhs. Correct? At this 0 time period, I am investing rupees 4 lakhs. Now this is my first year. This is my second year, third year, fourth year, fifth year, sixth year. Correct. After investing 4 lakhs, yearly if I check, every year, suppose first year, if I am generating now, let's talk about income. Okay, first year, suppose I am generating 70,000. Second year, I am going to generate 80,000. Third year, I am going to generate, suppose, 90,000. Fourth year, 1 lakh. Second year, 1 lakh 20. Third year, sixth year, I am going to generate 1 lakh 50. Okay. If I am using non-discounted method, means if I am using, suppose, payback period method, what you will do, you will just add all these cash flows. You will add all these cash flows till you recover your 4 lakhs. This is a normal calculation. As a layman, we always do. Okay, as a layman, we always try to add our future incomes, and by that we always say the answer. But when you are actually working as a financial analyst, or when you are working, or when you are reading finances, yes, so here we know one thing, that there is one term known as inflation. There is one term known as inflation, because of which prices are increasing. Correct? The same, if you are purchasing today one Parle G packet, you are paying rupees, the same 10 rupees, but that quantity that has been reduced. Correct? That same Parle G, if you would have purchased in a 2000 year, then at that time, by paying 10 rupees, at that time you could have received 10 biscuits in that packet. So that is the change. Though you are paying the same thing, but are you getting the same value today? No. Yes, the value is decreasing, or the price is increasing. Both the points you can say. By paying the same amount, we are getting lesser quantity. So why this actually happens? Because of time value of money, because of inflation. Your prices are increasing day by day. So as a financial analyst, when we are talking about finances, we are always going to adjust all our future incomes based on this time value of money. Based on this, discounting, inflation, we are going to adjust our future incomes. Here you can say 70, 80, 90, 1 lakh, 120, 150. All this incomes, all these are future incomes, and these are not adjusted based on inflation part. So first, what I need to do, I need to convert this. I need to adjust all these future incomes based on inflation. Correct? And for that adjustment of that inflation, I am going to use for this inflation adjustment time value of money. Means whatever money you are receiving today, that is not going to equal after 1 year or tomorrow also. Okay? So here we are going to use this time value of money to adjust this inflation. And for this adjustment, we use discounting. We use here discounting. Correct? Discounting. Means if I want to know what is the value at a 0 time period of all your future incomes, I will do discounting. Okay, so if yes, this is a 0 time period, and if I want to know today's value, yes, at a 0 time period, if I want to know the value, so what I will do, I will value the first year's income and I will discount it. I will bring it back by discounting by 1 year. So what is the formula of this discounting? Discounting formula, or you can say the present value formula. Under this discounting, we have two sides. One is your present value and one is your future value. Okay. So if you want to know after 10 years, after 12 years, the true value, that time you will use future value. But if you want to know the after adjustment of inflation part, what is the today's value at your 0 time period, that time you use this present value. And the formula for this present value is whatever the cash flow you are generating divided by 1 plus r to the power n. 1 plus r to the power n. This is the formula we need to use. So whatever income you are generating in your first year, that is 70,000 divided by 1 plus whatever the rate they are providing, every time they will provide in question. Power 1, because 1 year you are going to bring it back. Okay? Same for the 80,000. 80,000 divided by 1 plus whatever r they are going to give, power 2, because 2 times you are going to bring it back. Yes, for the fourth year, suppose 1 lakh divided by 1 plus r to the power 4, because 4 times you are going to bring back, because we are going to calculate at a 0 time period. Yes, now if I want to calculate for the 6th year, can you tell me? You will divide by 1 plus r power 6, because 1, 2, 3, 4, 5, 6. 6 times you are going to bring it back. So this is how you are going to use the power, and this is your discounted cash flow, correct, for when you are adjusting the inflation part. Now the first thing under this discounted cash flow is your net present value. Net present value. Now net present value means a rupee now is more valuable than the same rupee a year later. Now net present value used in terms of cash flow means the present value of all future cash flows. So basically here when we are talking about NPV, that is saying whatever sum of all future incomes present value minus, yes, sum of all future incomes present value minus your initial amount. Correct, your initial amount. And if here you get yes, more amount for your sum of your future income, you will accept the project. But if you are saying the amount you have invested today, that is more than the amount you are receiving, then you are going to do what? You are going to reject that product. Accept, reject. Accept, reject. Yes, so this is how we need to calculate time value of money. So net present value formula is what? Present value of net cash inflow minus total net investment amount. And if your NPV is more than or equal to 0, accept the project. NPV is less than 0, then reject the project. Now let's solve one question based on this concept. So compute the NPV for a project with a net initial investment 1 lakh, and the net cash flow for year 1 is 55, 80, and third year 15,000. Now what they are saying, that we are going with one project. This is a 0 time period, first year, second year, and this is a third year. In a 0 time period, you are investing 1 lakh rupees. Here this is your invested amount. This is your invested amount. Now in your first year, you are going to generate 55,000 as your income. Okay, and in your second year, you are going to generate 80,000 as in your income. Third year, 15,000 as your income. Now we want NPV. So first what we are going to do, first we are going to calculate all these future values, their present value, because all these are future incomes, and first we need to adjust it by inflation. So how I will adjust this 55,000 to bring it at your 0 time period? 55,000 divided by, now R is your 10%. R is your 10%. So what is the formula? Cash flow divided by 1 plus R to the power n. 55,000 divided by 1.10 to the power 1, because once only we need to bring it back. Now let's calculate for 80,000. So 80,000 divided by 1.10 to the power 2. For the third year, yes, what is the amount? 15,000. This is a 15,000 divided by 1.10 to the power 3. 3 times we need to bring it back. So let's calculate your present value of future inflows. So for the first year, what you will do? Just type 50,000. How you divide? How you divide? Suppose if I say divide 10 divided by 2. How you will do this? Just write 10 divided by 2 and you will press equal to button and you will say answer is 5. Correct? Again, if I say divide 25 divided by 5, how you will do with the calculator? Everyone please do with the calculator. How you will do it? 25 divided by 5. Correct? I hope you know how to calculate with your calculator the basic division. Okay. So if you know this one, if you know how to calculate with your calculator, then let's come to this part. Okay, now let's come to this part. What is the numerator here? That is 55,000. And what is the dividing figure? Denominator 1.10. 55,000 divided by 1.10. Yes, this is what we generally do, divided by 1.10. And when your power is 1, just press once equal to button. Just press once equal to button. Means for the 0 time period, if you bring this 55,000 1 year back, today's value is 50,000 only. Today's value is 50,000 only. You know what is the difference in case of power and in your basic calculation? Only the difference is your power. Yes, only the difference here is your power. Whatever power they are giving, yes, whatever power they are giving, just press for that power calculation equal to button, that is same time whatever the number they are mentioning as a power. Okay, means what? See, 80,000 divided by 1.10. What is your power? 2. So press your equal to button for 2 times. 1, 2. So your value, that is 66,115. Now, for the third one, 15,000 divided by 1.10. Now, what is your power? 3. So, how many times you will press this equal to button? 1, 2, 3. Your answer is 11269. 11269. So, what is the total present value of future cash flows? 55,000 plus 66,115 plus 11269. 127,384. Means today you are investing 1 lakh and by this 1 lakh you are generating 127,384. This is the income amount. So what is your NPV here? 127,384 minus 1 lakh. So your answer is 27,384. This is your answer. And this is how we need to solve your NPV questions. Okay? Now remember one thing, for more questions, for more better understanding, you can join my paid batches. So this is one more topic in your capital investment decision, but remember, for more practice you can join our upcoming batch. So for that you need to visit to Adda 24/7. Just scroll this up and JAIIB CAIIB, and here your attempt is JAIIB November 25. And you can join this officers batch, which we are going to start today only, that is from 2nd August, correct? In this particular batch, we are providing you conceptual classes, recordings, as well as the unit-wise test, self-study modules, so that continuously you can do your practice. Now, while registering this for enrollment, just click on buy now. But please don't pay 20,199 rupees. Better use one coupon code, and that coupon code is Y895. If you apply this coupon code, you need to finally pay around 4,040 rupees only. That is the benefit when you use the coupon code. And remember it, without this you are going to pay the higher amount. So better to save some amount by using the coupon code, that is Y895. So I hope you have understood 2 methods, that is NPV. I know NPV is quite difficult, but for that you can do the practice by joining this batch. And one more we have done, that is your payback period method. So now with this, I am winding up this session. Thank you everyone for joining. Take care and bye-bye.